Hello and welcome to the Price Action Analyst YouTube channel. Today I'm just going to do something non-cryptocurrency, and it's a review of an options trade that I've been in for 18 days. And as you've gathered from the title of this video, it's I'm done trading naked options. I think this was my last naked options purchase. So you can sell naked calls or puts, and if you're on the opposite side of that transaction, if you're buying them, then you're buying a naked option, a naked call or a naked put. So this time I purchased a call option, and this was on Costco. I purchased this 18 days ago, so it was on the 18th of June, which is right there. So let's mark this somehow. Okay, so I'll leave that cross there to mark the date. So I took this trade because I had a upward bias on this stock. After the COVID stuff, it came through, it made this low, and then it pops up, retested the low, popped up, retested that low again, consolidated and pushed out of here. And so, this low had been rejected multiple times, and it pushed up here, and then it consolidated. So this push up and this consolidation in the context of this history indicated to me that this price was going to push up. So it did do that. I was either late or too early, and I say late because this wick here outside of the Bollinger Band, that's your entry. So when price moved back inside that was really the time to enter. And this is when it gets complicated, because that's not necessarily the best time to opt to enter if you're buying a naked call, because, and this is with the benefit of hindsight, this was actually the best place to buy the naked call, because if you buy a naked call, it's a great instrument if you can pick exactly when price is going to run. So, I can sort of do that. What I'm doing here is I'm picking buying areas. I'm picking areas where I know the buyers will step in, but the buyers look at what the price action looked like. So yeah, you had a gap up, you had a wick and a gap up. So that's significant buying pressure. And then you had a consolidation down, and it looked to me like this was going to move down and pop up, and it did. But what happened? It sold, with this wick and this air here, maybe it sold down immediately and wanted to. I think there was a gap here that wasn't filled on the lower time frame charts, but I'll have a look. But basically, it pushed down into here again, and then, showed strength, which wasn't substantial relative to this, showed weakness, and then made a substantial buying bar. And so this really, I would guess that not this day, but this day here, when it pushed past this high, that was your time to buy the option. So let me just go through how bad, given that you can just buy the buying, this is the buying area, so I'm buying in here. This is how poorly, a naked option performs. So on this day here, on the 18th, I paid 5.7 for that option. It was a 302.50. So that 302.50 level is marked by that blue line. So, it's, and the next day, it's worth a lot less money. Just, and even here, I think I might have been slightly up, but I was losing money here. So, like I said, unless price just rockets in your favor, you're losing money with those things. And then price came back and made these series of buying bars, and I held it. Um, and so I'm not sure exactly where I broke even, but I sold that option today for 8.7. So that's let me just double check. Yeah, so I mean that's 50. I made 53%. So, I paid I paid 5.7 for an option here at, roughly, call it 300 even. And I sold today with the price $11 higher, and that option had not even doubled. There, in terms of intrinsic value, from 302 to zero point 0.5 to, let's say, 311.5. I mean, you're what, 8, 9, 9.5. That option's gone up, and you're paying 5.7 of time value here, and then it's an increase of 5, what did we say, 9.5 in intrinsic value, and the option, when you sell it's only worth 8.7. So yeah, it's a terrible, it's a terrible way to do business. And so what I'm going to be doing in future is, my trades are going to look like this. I'm going to be buying let's say that price is pushing down in this wick here. That's not what we want. So something like a 2950, I'll be buying a 2950 call and selling a 56, 7, 8. So, selling maybe a 298 call. Sorry, I'll make that the same color. And, you want to just, if price is down here, you want to buy the next call option, the strike price. It's the next strike price out of the money. Excuse me. So, if price was 295, then I'll buy the 2950, 295.5 call, and I'll sell the 298 for a 2.50, 2.5 difference. So I'll probably pay about 130, let's say 150 for that call, with a maximum upside of $100. So that's going to be, a 66% profit, and I only made, this call going all the way up here only made me 53%. So, that'd be roughly a 66% profit, and all that has to happen after expiry is that price has to be above this top line. So I got two things. Price no longer has to rocket in my favor. It just has to move up as I expected, which is a lot higher probability from a buying zone than price having to do that. And also, where you buy a naked call option, this whole time value is working against me. So the value of the option is decaying as the trade takes longer. Whereas, if price is above this top line, the longer we are, the more time that's passed, as that time value decays, this value of the spread's actually going up. So in my mind, just after getting to know, debit spreads, and trading call options, and trading call options from a point of view where I think I have some sort of ability to pick buying and selling areas, so I have an element of timing. I think that naked options are a loser's game, and that they heavily in favor of the seller, but until you've sold them and bought them and then seen what debit spreads and how they work and how advantageous they are, I think I think that was my last. That was the last naked options position that I take. I'm done with it. To see that and to see how little I made, it's really, you have to really get your timing right to pick that. And I don't have the ability to know that that's going to happen here as opposed to here. When, if you'd have traded this wick here, yeah, price moved pretty quick. So that, that would have worked. But all right, this had, strength going down into it, but, you've got to hit those. And so if it doesn't just push up like this one didn't, then, that whole time, basically, apart from this day, the whole time I bought that option, the very next day I was losing money on that position. Even as price started to go up, I was still losing money. So it was only that I broke even kind of around here. And that's, that sucks, I think. So I'm kind of done with naked options. The reason I sold today was I had this wick marked. So there's a couple of things. You can see I had these trend line marks, and you can see I expected it to push out of this trend line, but I also expected some weakness there, and you got the weakness. It pushed out and then sold inside. You also had this high here. And I expected weakness here because you've got the wick here, and you've also got this top trend line here. So again, I think this will eventually push out. But if tomorrow, I get a bearish candle and then it pushes out, like I basically gave up all the profit that I took today. So it's just I wasn't willing to take that risk because you could get a day of selling pressure here or two or three and then a push out, and then I'm losing money again. So again, in comparison to the option spread with the strike down here, I can afford for it to do that and step out. Price has to just stay above this level for me to collect the maximum profit. And the thing is, when prices move that far, instead of taking, exiting at 210 instead of 250, I can just leave the option and let it expire for the maximum 250 if I'm very confident that price is not going to come down and test here. And if there was 3 or 4 days left, then I would have just left that trade, because chances are, especially with this strength and what I think is going to happen, price is unlikely to come back down to where I would have initiated that spread. So I see way more advantages over debit spreads than I do with buying calls and puts. I think my days of doing that are finished. Just thinking about what else I can say before I go. Oh, that was the other thing. So, whereas that debit spread cost me, let's say 150, normally they're a bit cheaper than that, 1.5 with a maximum 2.5 upside. And that option position costs 5.7. So if I want to make the position the same, then the number of contracts I would trade in the spread would be 4 to 5 times instead of just one contract. So, it's very easy to make the size the same. If that's a concern for you, you just adjust the number of contracts you're trading. But again, every debit spread I've done that's successful, if you look at the individual option legs, it's a lot harder to make money on them than it is with the debit spread. So I think that's all. Just kind of disappointed with the performance of that option, given that it's not many people can you pick when that's going to do that, and it's still the option to me is the losing instrument. So, and I know that I've followed people on Twitter that are trading options, and they're trading breakouts on, if it closes as high the next day, they'll trade that. I much prefer trading in the context of, how I do it. I have an upward bias, but I like to hit these downside tests. When my premise is up or I think there's an uptrend, I want to hit these sorts of things here. I don't want to be hitting breakouts higher up. But funnily enough, with that option trade, this was actually, if I'd have gotten in here, I would have been far better off than getting in, here. So for what I do, I just prefer the debit spread. And I think, if you look at the probabilities of the probabilities on your option screen of them expiring in the money and that, you'll see that the probabilities are stacked against you, and I can understand why now. So hopefully this is helpful. If you have any questions, please feel free to comment in the comment section, ask me some questions. I'll do my best to get back to you. If you haven't been watching my chart videos, it's probably been a lot to take in. It's just this was about the Costco position, but it was also about how shitty I think a naked options instrument is for this type of trading. So if you have any questions, please let me know. If you have any requests for me to look at stuff, please let me know in the comment section. Please like and subscribe to my channel if you would. And also, I'm on Twitter at Price Analyst. This video will be up there as well, and if you want to forward that on, you're more than welcome. So thanks very much for watching, and we'll see you next time.